Welcome to Pencils Down, a Finalis podcast. This is a show for listeners wanting to learn more about the ins and outs of the private securities brokerage landscape. Each episode will feature insightful conversations with the world's leading investment bankers, placement agents, capital providers, startup CEOs, and more. And with that, let's get into the show. All right. Matthew Epstein, thanks so much for joining us here on the Pencils Down podcast.
You are more than welcome. I'm very excited, happy to be here.
I usually like to start by asking our guests to share a little bit about their backgrounds and their eventual paths into investment banking. I couldn't help but noticing that, similar to me, you also had a stint in law before finding yourself into this industry. And I'm just genuinely very curious, would love to learn a little bit more about your career path.
Yeah, I like to joke I'm a failed lawyer. So I actually practice as a lawyer, and not to malign the legal career, I actually think it was great unintentional training for being a banker. I mean that in all honesty. I think the great thing about law is it sort of forces this analytical rigor. You know, there's this concept in law called relevance. If something's relevant, you got to address it. And so that it sort of teaches you that, you know, to sort of really look at the issues in front of you, whatever they might be, and deal with them, even if they don't fit into some preconceived or nice, pretty array, shall we say. But anyways, I actually practice as a M&A lawyer and, you know, at a leading a firm here in New York. But it actually made me want to be more involved in the transaction. So, you know, lawyers play a critical role, but, you know, I was being given deals that in some cases, you know, the principals have been talking about for years, and I wanted to play a more integral role in sort of setting those deals up. And so that's what took me into banking, I'm embarrassed to say, you know, more than 20 years ago.
And tell me a little bit about that transition. So, you know, kind of taking the leap of faith from, I believe you were at Wachtell, a little known law firm in New York.
Little known law firm.
So kind of specifically, just curious, you know, what were the catalyzing events for you that led you to ultimately take that leap?
Yeah, so as I said, I worked, it was, very interesting, worked on a lot of large deals, but I wanted to feel I was on the front end of the funnel, shall we say, more on call it the middle or maybe the back end of the funnel. So, Wachtell's not a bad platform. So you tell people you're interested in joining investment banking, they interview you. I ended up joining Lehman. To a large extent, I felt the culture felt good. It felt sort of just sort of suited to my personality. I like to joke, Lehman, brothers, may they rest in peace now. And the transition was, in some ways difficult. In some ways, it wasn't. If you're going to the business, you work. You're going to work hard, and I really worked hard. And to be a little bit immodest, I was a math geek in high school, so I didn't find the mathematics or the analytics of the business difficult. But to be quite honest, I had to learn accounting and all those other things sort of on the job. And I will not pretend for a moment that was easy. But this was back in the 90s. Maybe the business was a little more accommodating then in some regards. In other regards, it was sort of, the crazy stories of managing directors flinging staplers at people's heads. Back then, at least, were true. So it was a bit of a grind, but I enjoyed it. I did well, sort of fell into the FIG group at Lehman, and out of that, I fell into fintech, or got a taste of it. I got sort of tapped on the shoulder and asked to sort of look at some investments for the firm, which I found, interesting. This is back in the late 90s, and these are early startups, and the world's changing. A group of senior bankers I worked with did a group trade, as it's called, from Lehman to UBS. They asked me to come with them, and I said, yeah, but I don't want to do this balance sheet bank stuff anymore. I want to do this weird fintech stuff. To which they said, fine, and here I am, 20 odd years later.
I mean, it's fascinating because, of course, at the time that you were at Lehman, I'm quite confident fintech wasn't even a term that was being used in the lexicon. And so tell me a little bit about, some of those early transactions that you worked on that really sparked that interest in you to focus on the fintech sector. What was it about the fintech space in particular that got you excited?
There's a couple of things. I mean, there was some of the people listening to this podcast may remember this name. There's a firm called Daytech, which provided a technology platform for day trading. as it was called back then. I guess you would now call it, proprietary trading, I guess is now what they call it. That term is no longer used much. What was interesting is it was a relatively small company that had really sort of come from nowhere and grown. We ended up passing on the deal because we just couldn't get comfortable on some background check information on the CEO. But one of the major private equity firms invested in it and did great. Silverlink actually invested in, had a very good return. But just seeing that, the ability to build a new business model relatively quickly. The other thing that was interesting was related to that, there was a company it was called the Island ECN. This is early in the alternative trading venues. And they came in one day, and I was part of the team that was asked to come in and look, and they showed on their own browser real-time quotes that were available to the public. Here's actually the bid-ask spread in equities. And to me, that was really eye-opening. So if anybody can see this, it's going to completely change the way in which people think about equity trading and equity execution. And sure enough, the markets look dramatically different now than they did in the late 90s. And it was seeing in real time the ability for that new technology to change so dramatically a business that to a large extent, was at that point, other than NASDAQ, and that was a new electronic platform, but had been around for a long time. New York Stock Exchange, the other exchanges, most of the trading was done in open outcry on the floor of the exchanges, heavily technology intermediated. So, so I'm not pretending it was sort of from horse and buggy overnight, but there's now very little trading done on any venues on physically on the floor anywhere in the world. And it was just sort of seeing the potential for that technology change that sort of made me want to be part of it, or at least be involved in it.
Yeah, absolutely. And it sounds like that sector focus has really become, a defining characteristic of your career, because if you then fast forward 20 years from the moment that you entered at Lehman, you took probably the most significant leap of faith of all, which really was to leave a larger boutique, DC Advisory, to form your own boutique investment bank, Newbold Partners. Tell me a little bit about that transition and, what there again might have been the catalyzing events or realizations that led you to want to start your own platform.
I would like to say it was all part of some brilliant grandmaster plan, but in honesty, there's definitely a big element of just dumb luck. But very good luck. I was unhappy at my prior firm, not to speak ill of them, but I was unhappy with the firm and was actively looking to join another firm, and was very close in a series of discussions. There was like the global head of TMT for a big international bank was supposed to fly in from London. We were supposed to interview the day New York shut down from COVID. And in a weird way, thankfully, because of COVID, those conversations stopped. And then the second thing that COVID showed me was, there was this brief period, as we should recall, early in 2020, everything just sort of stopped for about 6 or 7 or 8 weeks. And then everything sort of started to come back, and deals continued, and people talked about new deals, and it was clearly there was capital put to work. And, as the year progressed, my dissatisfaction with my current firm didn't change. I started realizing, I can't get on a plane, I can't go to a hotel, I can't take you out for dinner, but I can still do business. And I had this realization, and I was doing business. And it was sort of the catalyst to say, you know what, if not now, when, right? Why don't I just try and go do this on my own? And clients were incredibly supportive. And, very quickly, within a few weeks of leaving DC, had several mandates. Even in that stub year of 2020, it was, right. My standalone operation was profitable. It's been, not to brag, but to brag a little bit, quite profitable since I've gone out on my own. And, it was a bit of taking that leap of faith, but it was, to be quite honest, dumb luck. I mean, but for COVID, I'm highly sure I would have joined another firm. And so I keep using the word lucky, but there definitely was more than a little bit of that in it. But, there's a phrase a friend of mine or many people use, there's being lucky, but also sort of seizing it when it comes along. And so maybe I'll give myself a little bit of credit for that, and having just sort of the gumption to sort of up and do it. I mean, the name Newbold actually is funny. I formed the company when I was up in northern Wisconsin. So we have a lake house. Actually, my grandfather bought it way in the deep northern Wisconsin. People know where Rhinelander or Minocqua is. We're sort of equal distance from these two little towns. And it's not a town. The nearest incorporated entity is called Newbold. And so I turned to my wife and said, I'm going to do this. I have to come up with a name for a company. I said, what do you think about Newbold? And she said, sounds good. Go for it. And I checked the URL, of course, and found that nobody owned it. So,
Well, that is the critical element. You have to check the URL. That's it's so funny. That's very much the case with the ultimate naming of Finalis. But what's interesting there is in the same way that COVID created this opportunity for you, it also presented a new set of challenges. I mean, investment banking is such a human relationship driven business. And I think COVID really put the industry in a place where it had to almost reinvent to a certain extent how business was going to be done in a fully virtual and remote context. Tell me a little bit about what that experience was like for you, especially in the context of starting up a brand new boutique investment bank, to be forced to effectively launch and scale the enterprise in a fully virtual way.
It's a great question. I mean, continuing sort of the trend of luck. I mean, the one thing that was luck for all of the industry, sort of really starting in that latter half of 2020 and deep into 2021, business stayed great, right? We all know that M&A volumes continued to go up. IPO market was active. SPACs exploded. A certain amount of hangovers going to be suffered from that for probably a few years now. But overall volumes, overall profitability of the business truly exploded, and I benefited from that, and a lot of other bankers did, to be honest. I mean, what it did do is it sort of showed more than anything else you could do the business to a large extent virtually, right? The way you and I are talking right now, the proliferation of Zoom and other online video platforms. The business had, sort of going a little bit off topic, but if you think about when I joined banking, Excel was a relatively new application. Been around for a few years. There were still some older bankers who insisted on using Lotus for. Now I'm really dating myself. Lotus 1-2-3, and so technology has sort of been chewing this role through investment banking for years. I remember talking to senior M&A bankers when I was a young banker, and they talked about doing their DCF calculations by hand, right? And you would finish the calculation, and they would hand the results to typists who would type it up on these long books, and you would do a version. And so Excel has sort of ushered in this ability for anybody who's good at mathematics to sort of run endless calculations. And the virtual part of the world has allowed anyone, myself, a lot of the other firms on the Finalis platform to a large extent, to build platforms with a much smaller footprint, leveraging a variety of technology. The challenge and the benefit of that is, it sort of throws you back on your existing relationships. So your good relationships, you can use them. And I don't have to fly to the West Coast or to London or wherever it is to talk to a client. The challenge is, how do you get new business? And so I think what COVID has done, particularly the investment banking where it is today, given the big declines in value, is it's sort of breaking the business more into sort of a flow business, for lack of a better word. Investment banking covers a lot of stuff, but businesses that's based upon more of a transactional, higher volume flow kind of businesses, and something that's much more old school investment banking that's really based on trust. And if you've got a trusted relationship with a client, they're going to transact with you, you're going to transact with them. The challenge has been, how do you expand those relationships? And I did a transaction on the Finalis platform that you may recall, that I was hired by the client. I'd met the number two in the firm previously in person, but not in a business context, and had only I hadn't spent a lot of time with him. The CEO, I didn't meet him in person until we had one sort of drafting session before our first management presentation. Everything else was done virtually. And so I think you can develop those relationships of trust in this new virtual environment, but it's a challenge. You've got to find a way to come across authentic. You have to be authentic, but you have to also convey that authentic quality, that you can be someone who's trusted. And I think that trend in the business is actually going to continue, meaning sort of this bifurcation of the business more into more that are transactional flow businesses and more that are old school trust-based kind of relationships. The old classic, deep client relationship where the client really trusts you, you're a trusted advisor, a phrase I think is overused and people aren't, sort of thrown around too much willy nilly. But I think, that will continue. One's seen that development, with the rise of the boutiques even before COVID. And I think that will only get accelerated.
Yeah. It's interesting because, so totally agree with everything you said. And it's interesting because I also feel that, the norms are shifting in real time and the dust hasn't quite settled post COVID, but the world hasn't fully reverted to doing business the way business was being done pre COVID either. Right. And so it almost seems as if we're landing in a new normal that includes some degree of virtual, but also some degree of in person, where perhaps the bar for that in person interaction is higher, right? Or the criticality of that in person interaction, it needs to be there in order to justify the trip or the in person meeting. I wonder if the norms are going to be shifting to a point where you may be able to build and sustain new business relationships without meeting people in person. It's going to be an interesting thing to watch.
No, I think you're absolutely right. I think there will be a new normal. I think a new normal is beginning to develop. Lots of things change. And one of the things that changed for me was also my business model. So because of that realization, look, you couldn't travel. And to be frankly, to this day, if I can avoid traveling, I will continue to avoid traveling. In fact, this is embarrassing to admit, but I'm going to go on my first real business marketing trip since COVID in 2 weeks, which is maybe a sign more of my laziness than anything else. But
you love New York City. That's nothing to be ashamed of.
I traveled around New York City with great aggression or great enjoyment maybe. But the one thing that did happen as I did Newbold, I did shift the business a little bit unintentionally, but now intentionally. What do I mean by that? When people ask me what is Newbold, I say it's a fintech focused merchant bank that looks to not only advise but invest with clients. And so because of that, I do a disproportionate amount of buy side work. Right? You sell a business, you can't invest in it; it's gone. Um, and so I typically will take the approach: look, pay me a fair fee, but I'm going to like to take half of it if it's possible in equity. But the other, and I do that on these sort of retained buy side mandates that I have. The other thing I've done, and I've had some success, is trying to put together transactions outside of an auction process where I know there's an asset to be bought. I would like to own a piece of it. I go find a partner that I think that I can work with, and that element of trust. I know they'll trust me. I can trust them. If you go after an asset outside of a process, you sort of get one shot. Right there, you can't sort of flub it up. The owner of the asset's not going to come back to you a second time. And in those opportunities as well, I look to speak for capital beyond that which my partner can deploy on their own. So the great example of that is bought a business or worked on a transaction for about $1 billion. You know which one I'm talking about. Picked a private equity firm that I'd worked with in the past and had a good relationship of trust with them. They trusted me enough to have hired me on buy side mandates. We hadn't gotten them done. I'd known them for many years. And I sort of knew I had one shot. And I ended up, because the deal was outsized for their fund, and because I brought it to them and they were, generous people, ended up speaking for about 20% of the equity capital for my own investor relations. And being able to do that kind of deal also changes the dynamic. I actually did get a call from more than one private equity firm that I knew not as well as the one I worked with that sort of politely, reamed me out. Why didn't I get the call? And you sort of politely answered, I didn't trust you as much as I trusted the entity I worked with. And that sounds incredibly arrogant, but when it's COVID and a smaller platform said, you sort of want to use the arrows in your quiver, one might say, more effectively or more efficiently. And being able to do a deal like that, and we've worked on several more since then. We have a couple more in the pipeline. It changes the dynamic of your relationship with other people. So, you talk to new potential clients, whether they're asset owners, current asset owners, or people who want to buy an asset, and being able to do a transaction like that, they look at you a little bit different, not just as someone who's going to help them get a deal done, but as someone who can bring value added in terms of, getting access to a unique asset. And so, in those circumstances, frankly, people are, willing to talk to you to a greater extent over the phone or over Zoom. They're not as demanding as seeing you in person. You're perceived as bringing a different value added to the transaction, if you know what I mean. And I think that's also been a shift. I would have never thought of doing a transaction like that or structuring like that pre-COVID at my old firm. And so that's also another point I'm trying to say about luck, that because of COVID, I had the luck of launching Newbold because Newbold was my own firm, and I wasn't really constrained in any way about how I wanted to go about deals, other than they had to be legal and here with regulatory compliance. And so I knew I had this opportunity, and rather than taking another approach to it, I took this very specific approach to it, and I had the luxury of doing that. So I'm sort of rambling on here a little bit.
What's fascinating there is that what you were looking to solve for, to a certain extent, was, how do you build more trust in a client relationship? Being creative about building that relationship or deepening the ways in which you can deliver value with your clients certainly is one way to do that. And then another way to do that, which occurs to me, is by having a very deep sector expertise. And that's something that you clearly have been able to achieve, and that, on your website, it discusses how Newbold combines this deep fintech industry expertise with a track record of delivering thoughtful and insightful advice. And I wanted to return back to a point that you mentioned a little bit earlier in the podcast regarding this specialization and expertise on fintech. I'd be curious to dig in a little deeper on specifically your firm's experience in the space. And then I have to ask you, reflect also on, what we've seen, in the latter half of 2022, in particular, as it relates to FTX last fall around developments in the crypto space.
No, thanks for the great plug on Newbold. Look, I've been doing this for a long time, and you get to know the sector well. And in the specialization, for instance, we have several retained buy-side mandates where we get, paid a nice, monthly retainer. And the only reason we get those, right, of course, we like taking it because it helps pay the bills and covers the expenses. But people are effectively, they're doing that because of that kind of insights into the market dynamics, market trends, who the providers are. And that is an element that just comes from, having spent an awful long time in the industry. I think you may know, I took a sabbatical, lucky not smart. I missed the great financial crisis and went to work for a client before 2008 hit. I didn't see it coming, and gave a little bit more of the insight from the operational side, and that has definitely helped in terms of getting hired, but also coming with a very strong point of view. I like to think that I tell people what I would do if I were in their shoes, the owner of the asset, the person looking to buy an asset. And so it's funny, on the back end of last year, maybe to my detriment, my short-term detriment, but I definitely think my long-term benefit, I spent an awful lot of time telling clients not to transact. Valuations had really fallen down. There was a fair number of companies that wanted to launch processes or were looking to raise capital. And I said, oh, look, if you're for sale and if I wanted to buy you, if I want to be a buyer, or if you want to approach me from that perspective, yeah, I would say yes, right? Because it's a good time to buy. But if you're looking to maximize value in this market, I advise people to wait. And I think that, to toot my own horn, is this kind of, very straightforward, honest, if I were you, this is what I would do kind of approach, not looking for the short-term transactional benefit. And again, because it's Newbold's my own firm, knock on wood, we've been successful. I honestly don't have, short-term pressure to sort of generate revenue, worry about this year's bonus, that kind of stuff. So it's definitely been a benefit, both from just experiential and the flexibility that having my own firm and Newbold gives me. Going to your specific question about FTX, it's definitely an interesting time, to say the least. I mean, on one sort of very boring level, FTX is a story of just old school fraud, right? The CEO converted customer funds. It's sort of the classic kind of fraud. And you could argue, any business that takes customer money, whether it's a bank or an investment platform or anything, you see it everywhere. So I don't know if that what he did is anything specific to crypto. I think crypto allowed him to get away with it, to an extent. People clearly didn't do their due diligence.
You mean the frothiness around the environment, the funding environment?
Exactly.
Right.
the frostiness of the market, the sense of FOMO, fear of missing out. He sort of seemed to be this schlubby golden boy, for lack of a better word. And so there was definitely some, sort of sector oddities that, I think in a different time in a different market, people would have looked more closely and maybe said, what's going on here in terms of, the fund flows between these sort of affiliated entities when they shouldn't have been, converting customer assets from FTX to Alameda. I mean, going forward, I think definitely the blooms off some of the rose on crypto. I don't think it's going to go away. I think blockchain, I'm much more of a believer in blockchain as an enterprise solution. I take advantage of doing early stage investments with a group here in New York, which I have to give a plug for, called Tribeca Early Stage Partners, and do a little bit, although very little bit, on my own. And I'm an investor in a company called Earn DLT, which is basically using crypto enterprise, crypto backbone technology to make illiquid assets a little bit more tradable and trackable. So I think those kind of applications, crypto's not going to go away. It can solve a lot of problems, but I think you're going to see a real shaking out of the market. The last thing I'd say on this is, the SEC. A lot of people want to criticize the regulators. I would argue in the trading world, going back to that early experience I said to you about why I went into early stage of changes in trading and how back at Lehman, I thought that was fascinating. The SEC has very much had a hands-off attitude towards technology. I think that they've never wanted to pick winners. They've never wanted to pick. If you look at the proliferation of trading venues on the equity side, right? When I was a young man, there was NASDAQ and the New York Stock Exchange was pretty much it. We had an explosion of these things called ATSs. There's been some consolidation of them. The SEC always said, look, we're going to set the rules. We're going to let you guys beat each other up in the marketplace. And, I think they're going to be probably forced to take a more regulatory aggressive stance on crypto. But I think you see them very much as saying, we're not going to dictate technology solutions. We do want to protect investors. And I think, the view that, these assets are much more securities and fall under the purview of the SEC or one of the US, the CFTC. I think that's inevitable for things that take place on U.S. soil.
Would you say that more regulation is something that you would say would be a good thing for the industry as a whole?
I believe so, because I think more regulation in terms of creating clarity for providers and for market participants, for traders, investors, those kind of things, because it just sets the guardrails. Like, this is the rules of the game. And it's still been a little cloudy or gray or odd. The rules around equities are very clear, right? Your ability to offer equity securities to U.S. domiciled and individuals is incredibly constrained. Whereas the extent to which crypto assets are being offered by non-domiciled non-U.S. domiciled entities, FTX was based offshore. It seems to happen to a level that if they were offering equities, the SEC or the CFTC in the case of commodities or their instruments would come down like a ton of bricks. I think it shows that the regulators are maybe being too cautious. But again, I don't think the tendency in my experience in the U.S. regulators is they don't want to accidentally squash technological innovation and development. But I think it's going to come, and I think it will create that clarity as to what you have to do to appeal to U.S. participants, whether they be traders or investors or counterparties or whatever. So I think it'll be good.
It'll be fascinating to watch for sure. Matthew, we're almost 3 years into Newbolt's life as a boutique investment bank. And I thought it'd be fun to just kind of look back and reflect a little bit and kind of get your observations over big accomplishments that you'd like to plug, or, even just a reflection on, what might have surprised you about this journey in growing and scaling the platform that you weren't expecting when you initially took that leap.
Yeah, I'd say it's been easier than I thought it was going to be really honest. And that's a nice surprise. So I'd say to other people who are thinking of going out on their own, have a sober look at yourself in the mirror and think about your client relationships. So you have real relationships it has to be statistically relevant, right? This is a business where you need a large number of clients because they're not all going to transact. Some may not transact in your professional life. But if you really have good client relationships, they will probably support you wherever you go, as long as you're going to a firm or going to a platform that makes sense. So that, I have to say, was really a pleasant surprise. I thought it was going to be a lot harder. The other thing that's been a pleasant surprise is this sort of what I call this hybrid merchant banking model, which I didn't even think about when I launched Newbold. This idea of where the opportunity allows to take, half the fees in equity to potentially raise capital alongside clients. It's, frankly, on one point, it's much more lucrative, right? If you believe in the investments, the back-end economics are pretty nice. It also changes that client relation that you'd mentioned before, trust. If you tell a client, hey, I so believe in this deal, I want to have some of the equity, or I'm bringing you a deal where I want to take most of my economics in equity. It really changes the dynamic of discussing about how to go after the opportunity and what to do, and who to work with. And so that's been also a pleasant surprise. And I guess the thing I'm proudest of is, I mentioned this before, this sort of call it nearly $1 billion transaction. It's a very attractive asset. I had a very good relationship with the CEO. I knew the owner wanted to transact. And, that was called a feather in my cap. And also on a point about you're talking about trust, it was important to come to the company and sort of do what you said. And so speaking with my client, look, they wrote the vast, they were the ones who were putting most of the money up and playing that role of a advisor to them. When they met with the owner of the asset, we talked, we had, long conversations about this, when they were going to make the formal approach and what the kind of offer they were going to give. And the thing we talked long about was it was critical that they stuck to what they said they were going to do. And to their, unlimited credit, they did exactly that. They did what they said they were going to do in terms of time, in terms of value, in terms of how they're going to treat management. And the former owner, who no longer is an owner, was very, very pleased with the whole process. And that reflected, greatly on my client, and immodestly it reflected, not so badly on myself as well. So, that's sort of looking back over those 3 years. It's been, those three things. It's been strangely easier than I thought it was going to be. The big development was something I hadn't even thought about when I launched it, and then getting a transaction off that sort of had those characteristics. Those would be the three things that really stick in my mind.
Any exciting plans for Newbold up ahead here in 2023 that you'd like to share?
More of the same. We're working on a couple of very large transactions. And so it's really trying to build upon the success to date. Probably going to, have to hire a little bit, which is not necessarily a bad thing. Increase the scale of the operation.
Well, Matthew, speaking for myself as well as Finalis, we've been absolutely honored here to have the opportunity to partner alongside you and Newbold for close to a couple of years now, and very much look forward to the opportunity to build upon this partnership in the days ahead. Thank you so much for joining us here on the Pencils Down podcast.
No, thanks so much. And likewise, you guys have been a great platform and great partners, over these last, call it, nearly 2 years. The tools you guys have brought to the table have also been incredibly useful, to the point about talking about, a virtual experience, right? You and I, we've met in person more than once when you've been in New York. But this is, utilizing virtual tools. You support me and a lot of other independent advisors all over the country.
No, thank you so much for that. And look forward to continuing the conversation sometime soon.
All right. Thanks so much. Best to you and the whole team.
Thank you. Finalis is a broker-dealer platform with everything that M&A advisors, investment bankers, and placement agents need to succeed. We deliver a broker-in-a-box regulatory affiliation solution, replete with tech-enabled compliance, research and analytics, deal lifecycle management tools, and a first-of-its-kind deal marketplace. Learn more at www.finalis.com. You've been listening to Pencils Down, a Finalis podcast. Keep connected with us by subscribing to the show on your favorite podcast player. If you like what you've heard, please rate the show. That helps us keep covering the latest in the private securities brokerage landscape. Thanks for listening. Until next time.